The 9-member Bank of England Monetary Policy Committee voted by a majority of 5-4 to reduce the key interest rate. Governor Andrew Bailey, in remarks after the 25 basis points rate cut, added that there are real risks on both inflation and growth. 3 things you watch for with the meetings. First is, of course, the independence of the Monetary Policy Committee. You don't want them to look like an extension of the executive. Second is transparency and how the trajectory of data informs decisions, and that it's not a case of cherry picking to support a case. And thirdly is the integrity, which does not mean infallibility. Optimism is okay, but hiding the bad news or forging the data can lead to delayed corrections or just plain wrong actions.
Today's decision is based on 3 key judgments on the outlook for the UK economy and inflation, and our assessment of the risks around those judgments. So I'm going to set out each of these key judgments in turn, and then I'll conclude with the implications for monetary policy. The first key judgment is that disinflation in underlying domestic price and wage pressures is generally continuing, albeit to different degrees. Headline inflation is likely to pick up slightly further in the coming months, but we do not expect this increase to persist. Chart 1, which has just come up, shows the development of 12-month consumer price inflation since 2021, that's the white line, along with its components, which are the coloured bars. The largest driver of the rise in headline inflation over the past year has been energy prices, which are no longer pushing inflation down. You can see that in the orange bars, while the contribution from services price inflation, which is the yellow bars, has remained elevated. More recently, higher food price inflation has also contributed to higher headline inflation. That's the purple bars. In the shaded area, the chart shows how we expect headline inflation to peak at about 4% in September. In addition to the contributions from energy and food prices, inflation will continue to be held up over the coming months by a number of increases in regulated and administered prices, such as water bills and vehicle excise duty, that are not directly linked to underlying cost pressures in the UK economy. There are good reasons to think that this rise in headline inflation will not persist. Now, as chart 2 shows, excluding the impact of administered prices, there has been some further progress on disinflation and services inflation. Inflation in services prices that is more directly linked to cost pressures in the UK economy has therefore continued to ease, albeit gradually. And pay growth, a key component of cost pressures in the UK economy, has declined further recently. Annual private sector regular pay growth, shown in chart 3, that's the purple line, if you can detect it in the many lines, was 4.9% in the 3 months to May, about half a percentage point weaker than we had expected in the May report. Now, this is in line with a range of other indicators also pointing to a gradual slowing in pay growth. Annual pay growth is likely to ease further over the second half of the year. That's the purple diamonds. Intelligence from the bank's agents continues to point to average pay rises for this year of between 3.5% and 4%. That's the green dot. And the bank's decision maker panel expects pay growth to be just under 4% by the end of the year. That's the slightly hidden yellow diamond. We should expect this gradual normalisation in pay growth to feed through to lower services price inflation as we look ahead. But the risk that the recent rise in prices could feed more inflation, as illustrated in the inflation persistence scenario that we set out in the May report, has come into sharper focus. Higher food and energy price inflation, and some additional pressure from other components, has increased the peak in headline inflation we expect in September by about 0.3 percentage points compared to the projection we had in May. Food and energy prices are salient to consumers and often affect inflation expectations more than other prices. So we have to be very careful that this does not lead to any additional second-round effects on wage and price setting in the economy. The slight increase in the upside risk to inflation makes the second and third key judgments underlying our decision today all the more important. And these key judgments have not changed since May. The second key judgment is that a margin of slack has opened up in the UK economy and the labour market is continuing to loosen. While we expect it to pick up a little in coming quarters, growth in the UK economy remains subdued. Employment growth is weak and the ratio of vacancies to unemployment has fallen further. Surveys of capacity utilisation suggest growing spare capacity within firms. And here, risks are more to the downside. While real household incomes have risen over the past couple of years, consumption has not followed suit. The saving ratio remains notably above pre-pandemic levels, and we have for some time been expecting it to decline and support consumer spending. Consumers appear to remain more cautious than we have expected, perhaps exacerbated by broader downside risks to activity and the risk of more sudden adverse developments in the labour market. Now, the third key judgment is that the margin of slack will act against remaining persistence in domestic price and wage setting to return inflation to the 2% target in the medium term. While inflation is somewhat higher in the first 2 years of our August baseline projection than in May, a margin of slack in the economy helps fully to normalise pay and price setting dynamics in the medium term. Accordingly, as Chart 4, which has just come up, shows, conditional on the market implied path for bank rate, inflation returns to the 2% target in the second quarter of 2027 in our baseline projection and remains at target thereafter. There are risks on both sides of this projection. The extent of the shift in global trade patterns and how this may come to affect external pressures on UK inflation remains uncertain. Recent domestic news suggests that the risks to inflation have shifted slightly more to the upside. The near-term peak is likely to be a bit higher than we previously expected, and the risk of second-round effects means that it may take somewhat longer for inflation to return to target. But at the same time, there are slightly more risks on the downside to activity. Economic growth is subdued, the labour market continues to loosen, and consumption growth may take longer to pick up. That in turn could lead to inflation falling below the 2% target further ahead. Do we put more weight on the recent pickup in inflation and the risk it poses to inflation persistence? Or do we put more weight on the risk that the recent weakness in activity could lead to inflation weakness further out? Well, the answer is that we set monetary policy to reflect our assessment of the balance of risks. And we set monetary policy in a forward-looking manner to return inflation to the 2% target sustainably over the medium term.
Hello, welcome to Global Business Insights, where we look in more depth at headlines moving markets. In this episode, the focus is on the United Kingdom economy and yesterday's Bank of England monetary policy decision. The BOE MPC arrived at a narrow majority decision after Alan Taylor, an external member who had initially favoured a 50 basis points cut, later agreed to a quarter point reduction in the second round of voting. The UK Consumer Price Index rose to a hotter than expected 3.6% in June from 3.4% in May. We also saw a cooling jobs market. UK's gross domestic product also contracted 0.1% month on month in May. Stagflation is obviously the worst nightmare for policymakers, except this time the inflation hike was somewhat expected and is not expected to persist. Quite a brave assumption. Much unlike the United States Federal Open Market Committee, that is much less certain on the inflation trajectory, given the impact of tariffs and all the fiscal policy tax legislation. Some analysts think the United Kingdom dropping rates below the US puts more pressure on Jerome Powell, who Bailey yesterday described as a person of the highest integrity. The Bank of England noted the slightly higher than expected near-term inflation, also raising their forecast of peak inflation to 4% by September, but still expecting inflation to trend downwards to the 2% target by the second quarter of 2027. That's a long way off. They added that there were both upside and downside risks from sluggish economic activity, we could lead to inflation going to 2% earlier than they expect, or risks from trade patterns and the turbulent geoeconomics that could keep inflation higher than 2% beyond the second quarter of 2027. My sense is that in the UK, with little room for any fiscal support, as taxes could still inch up, a dampening of growth means inflation could trend down much faster than Bank of England expectations. One more rate cut, perhaps, but unlikely at the next meeting, depending on what inflation looks like in the second half of the year. Notably, lower than expected pay growth is already helping to bring down service inflation. So should the BOE put more weight on rising inflation, or should it act more in view of softer growth? Therein lies the uncertainty, and where data in the next quarter will shed more light. The governor reiterated that the gradual and careful approach to the further withdrawal of monetary policy restraint remains appropriate. While restrictiveness has somewhat softened, it's not altogether dispelled. Analysts are of the view that despite the divergent views of policymakers, the downward trajectory for interest rates will progress into next year. So further loosening is expected, barring a surprise in stickiness of inflation. A faster drop in inflation could imply interest rates are dropped even below the about 3.5% priced into financial markets. Shadow Chancellor Sir Mel Stride said rates are coming down to support the weak economy Finance Chancellor Rachel Reeves has created, with inflation almost doubling on her watch and unemployment rising. After the decision, the pound strengthened 0.5% against the dollar to $1.343, and two-year gilt yields, which are sensitive to rate changes, also rose 0.05 percentage points to 3.88% as investors interpreted the cautious but hawkish remarks as signaling a slower pace of future cuts. To other business stories, OpenAI launched GPT-5, a keenly awaited artificial intelligence model reported to be better at coding and agentic tasks than its predecessor, GPT-4, which it released over 2 years ago. Tests also revealed the model experienced fewer hallucinations, adding that ChatGPT now has nearly 700 million weekly active users. And on Wall Street, stocks initially picked up yesterday as markets shrugged off reciprocal tariffs and as new cheap tariffs were unveiled with broad exemptions. Apple ticked up after it announced plans to spend $100 billion on US companies and suppliers in the next 4 years. But indexes later closed lower after giving up gains as investors pocketed some of their profits in what has been a solid week thus far, with the S&P 500 eventually closing slightly down. The Nasdaq Composite still rallied to mark its first record close in just over a week. Still in the US, Trump nominated Stephen Miran, an economic advisor who has championed tariff policy, to fill a temporary vacancy on the Federal Reserve's Board of Governors. Trump signed an executive order to allow private equity, real estate, cryptocurrency, and other alternative assets in 401k retirement accounts for better returns and diversification. Trump also called on Lip Bhutan, the chief executive of Intel, to resign, claiming he was highly conflicted without elaborating. Intel shares fell more than 3% following those comments. Markets all over the world are shrugging off the impact of US tariffs that hit dozens of countries yesterday, with those not named in the list subject to a 10% baseline levy. Nigeria was hit with a 15% rate. European stocks opened higher as hope rises that a Trump-Putin meeting will lead to a ceasefire in the Russia-Ukraine war. Asia-Pacific markets traded mixed as we see Japanese stocks led by technology, consumer cyclicals and real estate sectors rising sharply, and the Nikkei 225 benchmark surging over 2%. Well, that's all we have time for on this very special edition of Global Business Insights. This is Bode Oshosami. Bye-bye.